Good evening, and welcome to the final session in our Family Life Enrichment series for 2022. And it is being brought to you by the Churches of God at Brayton, at Bourne, at the Garden St. James, and Silver Sands Christ Church. We've been having some interesting sessions, and on our finale of the series entitled Living Your Best Life, we are going to be looking at finances. In our initial session with habits and also in gerontology, the importance of finance was mentioned briefly. But tonight, we have with us Nikita Gibson, and she's an associate actuary, and her Instagram hashtag, my2cents.bb, is with us, and she is going to share on us on the pearls of wealth. Welcome, Nikita, and I hand it over to you to introduce yourself to our audience. Nikita.
Thank you very much, Marcia. That's appreciated for that warm welcome. Good evening to everyone who's joined us tonight. And I hope that by the end of this session, you have a better idea of where you are, where you want to be, and most importantly, the steps involved in getting there. So I'm not really one for introductions. I'm sure Marcia knows this now. So we'll just get started, and you can drop all of your questions in the comment box. And at the end, Marcia and the team for the Church of God will feed those questions into me so that I can answer for you guys. So let's begin. As mentioned, what we are discussing today is all about financial literacy, as well as taking a look at the perils of wealth. So there are a number of things that we're going to discuss tonight, and they're all going to be broken down into these categories. Investing in your future, what does that look like? What life cycle you're in? What are your life goals? Putting it all together. Summary, and of course, we can't end the night without some tips, right? So let's take a look at identifying your life season. I want to start by taking a poll, and your IT tech is going to drop the code in the chat as well as the website. So what we're going to do is we're going to go to www.menti.com. When we get to that site, we're going to input a code, and that code will be 91720004. The first poll is trying to get an idea of, what life cycle you are currently in, more or less what is your age group. So one of the things about financial planning and financial literacy is there are usually a set amount of things that I encourage persons to do at specific age points. It does not necessarily mean that if you haven't done these things at that age that you have therefore failed for that age group. It just means that you have room to grow. So what you're going to do is you're going to jump onto menti.com. You're going to put in that code. So just let me show you. So we went to menti.com. We're going to type in the code 91720004. Click submit, and you're going to see categories there about how old are you. And you're going to fill those out for me so I get an idea of the age group of the participants. So far, I have one person who would have done their code, would have logged in. We have persons who are above the 45 age range. Anybody else? Just log on really quickly so it gives me an idea of what are the age groups of the participants. Okay, so we have a few more persons. All right. Just want to give you guys maybe just another 20 seconds to get on there and to input your age group. So you just get an idea where you are at the moment. So menti.com, and the code is 91720004. Okay. So far, most of the persons, well, all the persons, sorry, are in the 45 and over age categories. Okay. We have 7 persons. 8, All right. All right, so I'm going to cut it off there for now. There is going to be one more poll that will happen tonight, quite similar to that one. So that way you guys, you've got the hang of it. So we'll just move on. All right. So one of the reasons why I always ask persons to identify your life season is that knowing where you are in life helps you to know where you need to go and how to get there. So what's your current life season, right? And what's the plan for the next you or the new you? So here's one age bracket that they speak about. We don't have any of these persons on tonight, 17 to 22. It's kind of that sweet spot in life. Financially, you don't have any or have very little financial responsibilities generally within this age group. Usually, the first thing on your mind is where's the next line? Where is the next hang out with my friends? That kind of thing. So we have then the entering the adult world, the 22 to 28 age group. Now for this season, this really gives you the first glimpse into true adulthood. Is when you get your first car, your first job, that first professional wardrobe. I still remember the day when I bought my first professional dress. It might be the first time you get to pay bills in the family home, etc. So for persons in this age bracket, I tend to encourage them to buy health insurance. That's for one. Buy life insurance, set up an emergency fund, set up a retirement fund, and invest in themselves. Now, as we go on tonight, I'm going to talk about the importance of all these things, and more importantly, talk about how these things feed into your financial planning and your financial literacy. Now, persons in the 28 to 33 bracket, so this is what we call the age 30 transition. You've kind of gotten the hang of adulting. You're really getting into the swing of things. When the date that bills are due. Usually these are persons who might be starting a family. They might be making some career moves. So for these persons, I tend to advise them, to take a look at their financial planning goals. And it's usually around home ownership, family, and investing. And of course, retirement planning, because by then they've definitely gotten a swing of 9 to 5, and they're definitely looking forward to retirement as well. So persons in that settling down period, that 33 to 40, this is the season that I always say, hopefully by then you understand all the intricate details of adulting. You have a routine and a rhythm for life, right? So for these persons, by then I would always recommend you to have an idea of what type of retirement you want. Do you want to travel? Do you want a vacation home? Do you intend to, if you fall ill, go into a nursing home or have at-home care? So knowing what type of retirement you want helps you to determine how much it's going to cost and how much you need to save now to get to those goals when you retire. Having your goals aligned with your financial ability is very important. I would love to have a private jet, but I can't afford a private jet. So I'm going to set goals that are realistic, not only within the goal itself, but the timeline in which I'm going to achieve this goal. Expanding your financial capabilities. Knowledge is always power, no matter what area or expertise this may fall into. So investing, you might want to create a business. And one thing that I know persons are definitely doing now is generating more than one source of income. Whether it be from at-home small farm to someone actually starting a thriving business. So we have the midlife transition, those persons in that 40 to 45 range. And by then you are seasoned in your career. You've definitely gotten a hang or hopefully gotten a hang of budgeting and managing money. So what you might be doing now is ensuring that the college fund is set up and it is definitely progressing towards being ready for when the kids are ready for college. You're going to have life insurance in place to cover your family for when you die. And I say when and not if. That's the one thing that's sure about life. And retirement planning, your emergency fund, and investing. For those persons now after the 45 into the late adulthood, you're now ready for retirement. You've started, your retirement plans are where you want them to be or where they're going towards. And more importantly, you're now ready to really enjoy what all of your hard work and planning has led to. So That's just basically a snippet of what I usually encourage persons to do depending on their age bracket. Now let's really look at the meat of the matter. What is financial planning, right? No matter who you ask, you will get different definitions. But my favorite one is actually the last one here. It's a roadmap showing your current cash flow and your ideal cash flow and all the steps in between. And that's exactly what we're going to do tonight. We're going to start by looking at where we are currently, where we want to be, and how do we get there, right? So let's look at current state. Where are you now? You want to build your future financial self. You need to know all of your streams of income. You need to know all your expenses, your assets, liabilities, and what your net worth is. Knowing where your money is and how it's working for you is one of the first things you need to do when you start to financially plan, whether it's currently in good times, bad times, it does not matter. Planning is always at the forefront, okay? So your current financial, your current income state might be salary, a business, or a side hustle. You might be an entrepreneur, so it might just be your business income, rental income, or investing, right? So knowing those and knowing how much those amounts are and when those payments are due is key. What are your expenses? So I'm going to break expenses into 3 categories. And these categories are fixed expenses, variable expenses, and discretionary expenses. And the names more or less tell you exactly what they are, right? But fixed expenses are the things that you know that amount, you know when they're going to be due. So whether it's your mortgage, your car loan, insurance, rent, you know that amount and you know when it's due, right? Your variable expenses are now those expenses which fluctuate based on the amount of the good or the service that you use. So the more water you use, the higher the water bill. The more electricity you use, the higher the electricity bill, right? And the same applies to things like gas, car maintenance. As you know, the greater mileage you have, the higher the car service, etc. Right? So these are variable expenses. And the only way that you can really manage or control variable expenses is by reducing your amount of usage. Okay, that's the primary way of reducing variable expenses. The last set of expenses would be your discretionary. Now, this is my favorite category because when most people come to me and they reach out, they want to know how do they save money? How do they, they're living paycheck to paycheck, or they might have lost their job. What can they do? The first thing I do is I look at your current state. So we'll look at where your income is, or the income you may not have because you might have lost your job or you may have reduced hours. And I'll take a look at your expenses. What are those expenses? And these are some of the areas that we cut. Discretionary expenses are the areas that are nice to have, but you don't really need. Being able to identify what our wants are versus our needs is going to be critical to any financial plan, right? So these are the key areas that we can cut back, and it's very simple. So for example, at the start of COVID, we were all at home, we were all working on Zoom or virtually. I stopped getting my lashes done. I started getting my nails done. And all those are things that I was able to cut back on, even though my electricity bill was higher because I was working from at home, and because my food bill was higher because I was eating all 3 meals from at home. I was able to cut down in certain ways. Entertainment was reduced. I wasn't going out. I wasn't paying for any grooming services. I had to wash my hair myself for the first time in a while, and there wasn't any travel, right? So this is normally the category that we first look at to reduce the amount of money that we are spending. Now, what are your current assets? And this is an exercise that I encourage persons to do every year. At the start of every year, I make a list of what my assets are. I make a list of what my liabilities are. And I call each institution to find out what's the value or the current balance on all of these things. So what's the value of your house? What's the value of your car? And what's the value? What's in your savings accounts, your checking accounts, your emergency fund, any of your assets? And the same applies to your liabilities. What's the balance on your mortgage? Or what's the balance on your car loan, student loan, or credit card? Knowing your financial health is the first step to actually making progress. And this is one of the things that people take for granted. And it's primarily because we are afraid to see those figures down on paper. But guess what? Without those figures, we cannot make an efficient plan to either get out of debt, or to be able to move from paycheck to paycheck to actually having savings, right? You need to start somewhere. Now, measuring your financial health, these are just some of the areas to consider. Your net worth should always be positive. Is it red or green, really? And your net worth is your assets minus your liabilities. So in this example here, this person has $10,000 in the bank account, $30,000 in their retirement fund. Their house is valued at $300,000. They owe $15,000 in student loans and $275,000 on their mortgage. So in this case, this person's net worth is $50,000. Now, this is important to know because anytime your net worth is in the negative or in the red, it means that your liabilities are greater than your assets. You're not asset poor, you're not asset rich, as people would say, but instead you are actually heavily indebted. And this is one of the first ways that you can test to see what your financial health is. Next thing would be your spending ratio. The recommended spending ratio is the 50-30-20 rule. And that's pretty easy to remember. 50% goes towards your needs, 30% goes towards your wants, and 20% for saving. And if you're not currently saving 20% of your income each month or each week, it means that there's room to grow. It doesn't mean that you have failed or you're not doing enough. One thing I always remind people is that we still have to live, right? And there are sometimes some months where something gets broken on the house, on the car, and you need to be able to make those payments, etc. So you might not be able to make that 20% all the time, but that's the aim that you're going to try to achieve at some point in time. Your debt to income ratio, and a manageable debt to income ratio is 30% or less. Okay. Your savings and investments. Do you have any? What are your savings currently? What are your investments? How much are they worth? And how are they currently measuring up to the current inflation or the current market? Income growth. How do you make more money? And that's always the question that I get. So for most of the slides that are going to be coming up, these are going to be taking you through an example. Don't be daunted by the quantums that I've used. I've just used these numbers because they're easier to see and just easier to translate in terms of examples. Okay, so short term. There are three types of goals that you try to, when you're building a financial plan. You have your short-term goals, so anything that's going to happen in the next 12 months. You have your intermediate goals, and you have your long-term goals. So your short-term goals, maybe pay off your credit card. You might want to do a debt consolidation. You might want to do some savings. So you decide you want to save $2,400 by the end of the year. You set aside $200 per year. You might want to add some money to your retirement fund. These are generally the types of goals that you find persons having for the short term. Now, intermediate is generally between 1 to 5 years. So you might want to be looking for home ownership. So you know that there are certain fees you have to pay, legal fees, valuation fees, quantity surveyor fees, etc. So you might decide, it's all about planning. You want to have a home in the next 2 to 3 years. So you decide, okay, well, this is the cost this is the amount of money that I'm going to need to achieve this goal. And then how do you set aside money each month to lead up to that point, right? That's the whole point of setting these goals. You might decide you want to increase your emergency fund or create passive income. Now, the long-term goals are more things that you achieve over more than 5 years, right? So college fund for your kids, retirement fund, and emergency funds are generally the three top long-term goals that most persons have, at least for a base. Obviously, many persons have a wide range of goals. So what are the tools that you actually need to reach your goals? The first thing we did was identify your life season. How old am I? Where am I right now in my life? And based on that, where do I need to be? Or where should I consider being? What are my goals? Short-term, long-term, intermediate goals, what are they? How much money do I need to reach those goals? And what is the timeline for my goal? And those latter two are very important because a lot of people tend to make unrealistic goals. And then that's one of the worst things that you can do because Making unrealistic goals usually means that at some point in time, you're going to become frustrated with the process, and you may stop, you may falter, you may do some spending because, I don't know about you guys, but I am an emotional spender. Have a bad day, I might want to buy a pair of shoes. So those are all impulses that we have to be able to control. So don't set up your emotional failure that will lead to your financial failure, okay? So realistic goals, realistic timelines, and realistic amounts. How do you actually invest in your future, right? What are some of the things that you can consider? What are some of the investment tools that are out there? And we are actually going to our next poll again. And we have, what do you currently hold in your financial portfolio, right? So if you go to Menti.com, and you type in the code 9230728, you will get to the second and final poll, I promise, and it will pop up and you'll be able to vote and say what you're doing. And this is just some pretty basic stuff here in terms of investment portfolios. So maybe you don't have anything as yet. Maybe you are just your savings or your current account, your checking account. Maybe you have some bonds, some stock and equity, a pension plan, whether private or company, term deposits, or maybe you are a real estate investor. But either way, pop on to www.menti.com and insert the code 9230728. So I'll give you guys a minute to just pop in and do that code, that poll really quickly. It gives me an idea of what our audience is doing in terms of their current investing. Okay. That's good. So I didn't create this to be an exhaustive list. So I apologize if it doesn't have on everything that you have in your investment portfolio, but just pop on in there. And there were 9 persons who would have submitted their ages. So I'm expecting at least 9 responses on your investment portfolio. We have 4 so far, 5. Okay. All right, any more responses? I want to close this off in the next 15 seconds. All right. Well, we are missing 1 person who would have put in their age, but that's not a problem. So we have 1 person who is none as yet, 4 persons, their savings and checking accounts, and 3 persons with a pension plan. Okay, so that's good. So let's look at some of the ways in which you guys can plan for your and invest in your future. All right. So it's all about identifying how you want your life to be and putting the steps in place to reach the future you, right? And that future you could be at any timeline, today, tomorrow, 20, 30, 40 years from now. So here are a few tidbits that I would like to share with you guys this evening. Now, as simple as it seems, the 2 things that would have popped up before were on the poll would have been savings and checking accounts or our current accounts, right? Now, despite what we may think, a lot of persons actually don't use savings and checking accounts the right way. So I'm just going to share some information with you, right? You should have at least 1 main savings account. And really and truly, I actually encourage persons to have 3, 1 for each type of goal, short-term, intermediate, and long-term, right? So if you know that your short-term goal is to travel at the end of the year, you know your intermediate goal is to purchase a piece of land in 3 years' time, and your long-term goal is to build a home, then you set up those 3 accounts and you save accordingly, right? And the reason for that is that it creates some separation between what you're trying to do and what you're trying to achieve, right? Now, these savings accounts are separate and distinct from your emergency savings account, and I want that to be very clear. So really and truly, you're going to end up with 4 savings accounts. So my recommendation, and this is something that I practice, with the same dedication that you pay your bills each month, you pay yourself, okay? Those 3 savings accounts for each of your goals are how you save or how you pay yourself. You're going to aim to reach that 20%. If you don't reach 20% of savings, that's fine. Whatever amount, no matter how small it is, put it into the account, okay? Now, checking accounts. You should have at least one checking account. To be honest, you only really need one, right? And your checking account is what you should be using for everyday spending. So all your bills, all your loans, all those items, you buy a drink at the shop, you buy lunch, you take that out of your checking account. Your checking account is the account that tends to be fairly active. It's the one that has the majority of your transactions on there. And my recommendation is to set up a checking account which incurs no monthly fees, and each month transfer the amount that you need for your fixed, variable, and discretionary expenses. We all pretty much have an idea of what we spend each month. Transfer that money into the checking and use it for such, so that you don't touch your savings. Your savings are completely separate, right? So this is the recommended way of actually using savings and checkings accounts. Now, throughout this, we're going to be doing this example. And again, I use these numbers just simply because they were easy to use in terms of an example, but not necessarily, they may or may not be in line with someone's current salary or income position. So in this example, the person has a net salary of 10,000. They are trying to save 2,000 per month. That's their 20%. Their short-term goal is that they want to travel in the next 12 months. It's going to cost $4,000. So they want to purchase a ticket in 8 months' time. And so they will need to set aside $500 per month. Their intermediate goal, however, is to purchase land for real estate investing in 2 years' time. Their legal fees, they've estimated to be around $6,300. So in order for that money to be available to purchase the land, then instead of it being ready in 24 months, they want to be a little bit early. So they want to save it in 18 months. So that's $350 per month. Their long-term goal is to build townhouses or apartments in the next 5 years. The legal and other expenses, they've estimated to be $54,000. And available in the next 4.5 years, because you don't want to wait until year 5 to have all the money. It means that they need to set aside $1,000 per month to reach that goal. So what does that really look like for this individual who gets a net salary of 10,000? This is what that look like. They identify their short term. They know how much it costs. They know the timeline that they want to reach it. Based on their salary, they decided this is the amount that I can afford, that I need to set aside to reach that goal. Sometimes when you do these calculations, you might identify, okay, $500 per month is too much. I can't afford that at this point in time. So I'm going to have to either change where I'm going for my trip or extend when I want to travel. So maybe I'll do it instead in 12 months, I might decide I need to travel in 18 months time, right? So those are the kind of decisions that you make. But the only way that you can make those decisions is by actually having those figures and those finances down on paper, all right? So your emergency fund. Now, I've mentioned this a few times this evening. And one of the reasons for that is one of the things that COVID would have taught us is that it's important to plan for the just in case, for that emergency that is unforeseen, we wish would not happen, but could happen. It just so happens, yesterday I was talking to a friend of mine, her son was outside playing and he broke his arm. And that immediately meant that she then had medical expenses because he required surgery yesterday in order to set back his arm. And that's unforeseen. And that's one of the things that an emergency fund allows you to do, or emergency savings, right? It's to break the glass in case of an emergency. That is what it should be used for, nothing else. Don't use your emergency fund to travel, to shop, any of that things. And between COVID, the La Soufrière and Hurricane Elsa, I think we've definitely learned the importance, and it was a hard lesson to have had, that, everything can actually go wrong all at once. And, that's one of the things that comes from Murphy's Law. So my recommendation is set up an emergency fund. You don't need to be able to fund everything from that emergency right away, but set it up, have it there. And your aim is to have at least 6 months of your gross salary saved in that fund, right? Ultimately, you would like to be able to reach 12 plus months. And one of the reasons why I say 6 months gross, some persons say 6 months net salary. You have been able to, you know how to manage your expenses and your day-to-day from your net salary. But the gross salary just gives you a little extra buffer, more or less. And that's what that's for. But essentially, I indicate 6 months because for persons who lose their job, it takes on average 6 months to find another job. And for a lot of persons who have gone through the pandemic, it took much longer than 6 months. There are people who are still not working coming out of the pandemic. And I know that had they had an emergency fund, it would have definitely helped them to go through this very tough period, right? So I think that that's one of the important lessons coming out of the last 2.5 years, is that we need to save and set aside for the what if, all right? So again, losing your job, for medical bills if needed, and for unforeseen major repairs, home repairs, might need to repair your roof. Your car might need an engine or some other expensive maintenance or repair, right? So that's what that emergency fund is for, not your regular savings. So back to our example. So this person, they would have taken out already for the trip. They were already taken out for the land and for the legal fees for the building. The next thing they want to do is that they want to save 1.5 months of salary in the next 12 months. So they've added another short-term goal, right? And they've decided that they need to set aside $1,250 per month for the next 12 months towards their emergency fund. And the beauty about having an emergency fund is if you don't have an emergency, it's just savings, right? So that's just key to note. Life insurance. Now, this is an area where people always have mixed reviews when it comes to life insurance. And, a lot of persons have the perception that life insurance, they pay all this money and they don't get anything in return. So it's not one of the most popular tools, but it is something that I would like you to consider. And these are just a few reasons why, right? Now, insurance is actually a good investment and security tool. And that's because it combines two things, right? It combines security for when you die, right? And it also can give you an investment portion as well. The challenge with life insurance usually or tends to be that people just don't understand how it works. So let me just spend a little time and explain to you how life insurance works and how you can actually use that as a part of your financial planning. So as we know, life insurance, you walk into a carrier, you tell them how much money you would like to be insured for, you pay them a premium each month. When you die, that payout goes to whomever you've listed as your beneficiary or your estate, right? So one good thing about life insurance is it's protection for your family, not just protection for you in the now, but protection for them in the future. If you have a spouse, you have kids, it provides them with that security that that extra blanket in case, when you die, so that they can continue with the financial burdens and financial expenses. One of the things that we see a lot within Barbados, for example, is that there are a number of persons or families that the breadwinner in that family, whether male or female, passes away, and then the family lose their home, they have to downsize, or in some cases, they simply lose their assets to the bank because they can't afford to maintain the house or the car or anything of the such without the income from that person who's passed away. And just even before you get to that point, even funeral expenses, right? And so that's one thing you can do for your family, is to ensure that they don't have that financial burden when you pass away, right? Now, simplest thing, as I said, you pay that premium. When you die, they pay out. But how do you actually use insurance as an investment? I'm going to focus on one type of insurance tonight. I mentioned two here, but I'm going to focus on the endowment insurance. Now, the way in which endowment works is that an endowment insurance, you pay, let's say, for example, I think I gave an example here. You have an endowment to age 65. And as the name suggests, it pays out at age 65, right? This is not one of those policies that covers you for your entire lifetime. Now you pay your premiums, you're 40 years old now, you're paying your premiums every year, you die at 55. Your family gets that payout. Your children, your spouse get that payout, right? Now however, in the other case, if you are 40 and you're paying those premiums, when you get to age 65 and you are alive, you get that payout from the insurance company. And this is one of the things I always tell people, that you need to understand the type of insurance product that you have. I always have this conversation. People tell me, oh, I already have life insurance. Okay, no problem, cool. What type of life insurance do you have? And most people are unable to answer that question because they simply don't know, right? And the type of insurance definitely helps to identify if it will cover your purposes or not. So there's whole life insurance, which will cover you for your entire life. You pay that premium. Whenever you die, they're going to pay out to your beneficiary. There's no payment to you if you survive, because that pays out. That goes all the way up to age 100. I think there's some policies now that go up to age 120, right? And there's term insurance. They'll cover you for a specified amount of years or up to a specific age. And you're paying those premiums whenever you die, as long as it's within that period, they will make that payout. If you live at the end of that period, the policy ends. And there are purposes for each type of policy. So it's not a case where you're just paying out this money, you're not getting back anything in return, but there's usually a reason for getting those types. And that's why it's important to understand the types. So one of my recommendations here is that you consider getting an endowment policy, because it allows you to not only have the life insurance element, but it also forms a part of your retirement planning. So you can have an endowment at age 55, you can have one at 65, and you can have one at 70, right? And those are around the kind of age groups that people want to retire at, right? So really and truly, you've now commingled two of your goals within one. So it provides the life coverage you need, peace of mind for your family when you die, and it can be used as well for creditor insurance. So when you're getting your home, that's the other thing about life insurance. All financial institutions in Barbados now require you to have life insurance in order to get a mortgage. And the reason for that is that you put the financial institution as the beneficiary, so that when you die and you're not finished paying your mortgage, they will pay off the mortgage and the excess will go to your estate or any other named beneficiaries, and your family does not have to lose the family home because you, the breadwinner or contributor to that household, has passed away. So back to our example again, the last thing we did was to add an emergency fund. This person has decided that they want to add an endowment policy, and that policy is costing them $1,000 per month, right? What about pension? RSPs, your company pension plan, NIS. Now, I don't know about you guys, but this is one date that I know very well. I know when I want to retire. I am almost certain I'd like to retire tomorrow, but realistically, I know when I want to retire. The important thing about retirement is knowing what type of retirement that you want, okay? How do you want to retire? When do you want to retire? What does that life look like for you? What is your health care plan for retirement? And this is something that people tend to forget as well. So for example, if you have a company health plan, I saw someone mention RSPs and pension plan. So we'll get to that as well. If you have a company health plan, what happens when you retire from that company is that most, not all, but most companies, that health benefit ceases after a period. And usually they might give you that health benefit for an additional year or two, but it's not available when you need it most. Like when you get into your 70s and 80s, as we age, we tend to need more medical care, right? So that's something that I always tell people to remember. Your company health plan is not necessarily going to be rolling over and available to you all throughout your life, even after you retire, right? So I encourage people to find out, first of all, what age their health plan ends with their company. And if it doesn't take you all the way until death, then what you may need to consider is getting a private health plan, because the younger you are, the more insurable you are, and the cheaper it is as well, right? Waiting late on in life to get health insurance is pretty hard or impossible to do. Identify what's your family plan for retirement. Now, there are always people who want to retire at 50 or 55 or whatever the case may be, but I always ask them then, at what stage is the rest of your family at when you are going to retire at that time? Will your spouse be retired as well? Will your children be finished college? Will you still have to be supporting them in any way? So all these are things that you want to take into consideration when it comes to retirement, because if you are still taking care of your kids, it means that your cash flow at retirement needs to be of a certain amount in order to maintain that financial assistance that you're giving them. How much does your retirement cost? And what can you afford when you retire? That's always very important. So I recommend setting up a personal pension plan or RRSP, right? And aim to pay the maximum contributions allowed in your company plan. And that's for persons who have a company plan. So let's focus on one thing for the moment. And this is going to feed into our example. The average cost of a nursing home in Barbados is $2,500 per month, average cost. The average cost for 24/7 home care in Barbados is $7,200 per month. And these are actual costs today, which means that they're going to cost more later on in life. And these are some of the things that you want to think about. You know, we live in a culture where we assume that our family is going to take care of us in our old age, but you might want to put some safeguards in place. Will you need some at-home part-time help, maybe daily help, 24/7 help, or are you maybe even open to a nursing home care? So these are the types of things that you ask yourself when it comes to deciding your retirement. So in this example, we would have done the life insurance. Now this person is going to set aside for their pension plan. They decided to increase it because they are going to consider a nursing home when they retire. So now they're going to contribute $1,600 a month to their pension plan, right? They've increased it by $500. Now, investments. Here is something that you may not know or maybe never even said out loud. You will probably never build wealth from your salary alone unless you are making times your net worth after all of your expenses, okay? So that's very important to know. You're not going to build wealth, not that you won't have money, you're not going to build wealth from your salary alone. So research and educate yourself before pursuing any investment. Check with a professional. And remember, one of the things about investing is that you can win or lose. Markets do go up and they do come down, okay? So for investing, ensure that you can endure the potential of losing money on an investment. That's one of the first things. Knowing what your risk is, what's your risk tolerance. Will I be in a financial detriment if this fails? Am I willing to take that chance? Yes or no? Is there a portion of my money that I'm willing to lose? At what point am I willing to pull out? All of these are conversations that you need to have before investing in anything, right? So for investing, there are 3 categories for risk. Are you risk averse, risk neutral, or you're a risk lover? And knowing which category you fall into really helps in determining what type of investments you might want to look into. So for the risk averse person, they tend towards things like fixed deposits and bonds, etc. Risk neutral, that person's insensitive, so they can do a combination of investments, risky versus lower risk. And then you have the risk lovers who might enjoy the volatility in the market and in investing. So here are some options currently for investing locally. So you have your fixed deposits, you have the government boss bonds, and I think that those bonds are currently giving a 5% return, so they're pretty good. You have mutual funds as well as other funds through Fortress, Sagicor, Royal Fidelity, NCB is on the market now. You also have Signia Globe as well, that I would have mentioned there, and of course our credit unions. Now insurance, the endowment plan, as I would have mentioned, there's another policy as well that is really good. It's called a life paid up at age 65, right? And as the name suggests, it kind of gives you an idea of what the plan is about. It gives you, it says life. So it gives you coverage for your entire lifetime. At age 65, paid up. So what it means is that age 65, you stop paying premiums on that policy. And that's the beauty in that policy, because at age 65, you're retiring or about to retire or retired already. And you don't, that's just another expense. So why not get a policy that still gives you life insurance coverage all the way to age 100, but you stop paying the premiums on those at age 65, right? It's a great policy. And I think Sagicor, what they just did is that they allowed you to combine the life paid up at age 65 and an endowment at age 65. So not only do you stop paying premiums at 65, but you also get a payout at 65 as well, and just in time for retirement, right? So it's how you understand all the products that are available, and then how you actually use them as a part of your financial plan or a part of your tools. So some of the, what I call non-traditional, they're just non-traditional because culturally these are non-traditional for Bajans. But you have the international markets. Alternative energy is very big now in terms of investing, whether it is solar, wind, or otherwise. You have peer-to-peer lending at Carry Land, and of course, real estate. I think one participant actually indicated that real estate was part of their investment portfolio. So in this example, this individual, they're working towards 5 years down the line getting these 2 townhouses, but they've taken it a step further. On top of getting these townhouses, they've decided they're going to add solar panels, and now their project is not only going to provide them rental income, but they'll also gain income from the solar system as well. So the last thing we did was add on the pension. We're going to now add the real estate. So they're going to set aside $1,000 per month in order to invest in that future plan. And this is what's involved in financial planning. You know where you are, you know where you want to be, and you identify the steps in between to reach to that goal. And just so you know, financial planning is something that can change at the drop of the hat. You must be able to be flexible. The plan I made at the start of the year is not the plan I have 6 months in, right? And you must be able to have that flexibility when it comes to financial planning and planning for your future. What's key is always finding a balance. I usually tell people finding balance. I relate it to when I was at university. A student's life, you live on ramen, you live on tuna, all those things. And to this day, I still love tuna, but I can't stand ramen. But that doesn't mean that I need to eat caviar every night either. Finding that perfect balance. You never go too far left or too far right? You must be able to live and enjoy life while still trying to meet your goals. And I know that sounds like quite a bit, right? But I always tell people one of the links, one of the very close links when it comes to financial health and wealth is mental health as well. And being able to find that balance in there that works for you. Never overextend yourself. There are persons who go to the bank, they qualify for $500,000 for a mortgage, and they take $500,000 for a mortgage. And one of the reasons why we always say don't overextend yourself is that you never know what your cash position is going to be in a few years' time. You never know where you're going to be. If you lose your job and you have to take a job that pays less, for example, will you still be able to maintain that mortgage or that payment? That's one of the first questions I get to persons who are finding it hard to meet their mortgage payments, especially for younger persons or persons within that 30 to, 50 age bracket, for example. I always share what my plan was. When I got my home years ago, I had always told myself that if I ever found myself in a bind and I could not afford my mortgage, I will do all I can not to lose my home. But the one thing that I wasn't going to do was to hide. So the first thing you need to do is speak to your financial institution. That's one of the first mistakes people make, and that's not communicating. And not communicating is usually what leads to financial institutions not willing to work with you or restructure, etc. The other thing is, if it gets to that point, and only if, of course, consider renting out your home and moving into a family home. If that's not possible, finding someplace that's much smaller and renting that, so that the amount that you're paying in rent is far less than your mortgage, but your mortgage is being paid for by the rental income that you're gaining. That way you keep your asset and you are able to still have some place to be. And that's something just for consideration. I know no one likes to lose their home, but that was always my safety net or plan if I ever needed it. Kind of a last resort plan. So in summary, we talked quite a bit tonight. So in summary, I will say identify your goal, your timeline, the cost of the goal, and make sure you write it all down, whether electronically or on paper and pencil, doesn't matter. Set your financial plan in line with your goal and start working towards it. Now, this is just a summary of the recommendations I've made. Savings account, pay yourself with the same dedication that you do your bills. Checking account, that's for your monthly transactions, your monthly needs, or anything you do throughout on a daily basis. Your emergency fund is key. And if you don't have an emergency fund, that's fine. Open an account and say, this is my emergency fund. One of the things I do for just sometimes you kind of have to trick yourself or trick your mind. What I do for my emergency fund is I put it somewhere where it's a bank or institution that doesn't have too many ways in which I can access the money. So those banks or financial institutions that either don't have internet or mobile banking, or it's not very good, or it's just average, those are the ones I tend to use because it's harder to access the money, and therefore it's harder for me to spend that money and on unnecessary things. Life insurance, I've mentioned two options here for life insurance, the endowment policy, as well as the life paid up policy, pension plan, and then investing. It's very important to research and educate yourself before pursuing any investment. So here are some tools that I personally use, and I encourage you to check out to see what may or may not work for you. This is absolutely my favorite app. It's called the Wallet app, and it has a free option, but the paid option has unlimited usage, and you can set up as many accounts as you want. In this app, I set up the amount. So if I open that app now on my phone, I know how much money is in my purse. I know how much money is in all my savings accounts, checking accounts, the balance on mortgages, car loans, anything at all. And you put it all in this app. If I walk to the corner store now and I buy a Coke, I put it in the app. And at the end of each month, it allows you to be able to see how you're spending your money. And that's very important. Sometimes before we start to make a financial plan, we need to understand what it is that we are currently doing. And then that helps to inform us what we can do better. Okay. And this is one way to do it. And one of the reasons I encourage persons to get apps like these, it doesn't have to be this one, is that I always hear, I have no idea where my money went. And that's a common phrase. And this is one way in which you can definitely track where your money goes. And the app has a very annoying thing, but good thing. It lets you know how much money you're spending in wants versus needs. Because every time you input a transaction, you have to indicate the category for that in transaction, whether it be groceries or shopping. So obviously it's going to show shopping as a want and not a need. So that's not a priority. It does a very good job of reminding you of that. The other thing that the app can do, you can actually set budgets in there. You can limit the amount of money you spend on, let's say, lunch every day when you go to work or some other thing. For those who are interested in investing, Interactive Brokers is a pretty good platform that allows international account holders to set up accounts. You have to be able to fund these accounts with US dollars. So obviously you will check all the exchange controls protocols with the Central Bank of Barbados before pursuing investing. And of course, educate yourself before you do, or just stick to having an advisor to manage your funds otherwise. Kraken, for those who might be risk lovers, Kraken is a platform that you can be, if you're interested in the cryptocurrency space. I'm personally not, I'm not that much of a risk lover. So for those who are, that's one that I know that does international accounts. And of course, I've been talking about self-improvement and investing in yourself. So here are some of the apps or websites that you can look to do additional things. And it's a great way to pick up additional skills as well that you can use. And in this day and age, everyone is looking for a way to make additional cash, right? So why not use like Coursera? There's also, I think it's Udemy that allows you to be able to do a wealth of courses on there. And maybe there's something else that you can pick up to make some money, some additional money, right? So that was quite a mouthful. And I hope that it was informative. I hope that you've been able to learn something from tonight, even if it's just one thing. And so I'm going to open the floor now to questions. As Marcia would have indicated at the start, you can actually find me on Instagram at my2cents.bb. I post there, usually it was very frequently. I've been doing a lot more of these talks, so therefore I've been posting a lot less, but you can expect to see posts from me coming out next week on how to battle the inflation that we're currently experiencing. So the high prices, things to consider. How can we more or less adjust and help each other? And you can always contact me via email at nikita@claritylifeinsurance.com. So that ends my presentation. So I'm just going to hand over to Marcia and the team. Just let me know if there are any questions and just for me to respond to them. So over to you guys.
Wow. Thanks, Nikita. That was a lot of information. But I did pick up a few tips, and I hope that some of the other persons in the chat were able to do as well. One of the questions that came up that I saw, some of the terms I am familiar with, but that may have presented a challenge was the debt to income ratio. You mentioned that, and I was not sure how that was calculated when you spoke of monitoring your debt to income ratio.
So the way
total, sorry, go ahead.
Go ahead.
No, I was wondering if it's total debt to annual income. I wasn't sure what we were looking at there.
Okay, so that's usually based on your monthly figures. So most times when you go to the bank for a loan or for any facility from the bank, they will normally give you an application form. You have to list out what is all your income, how much you pay per month in any loans that you may have. They might include things like your insurance, etc. So there are two debt ratios that banks look at, and there's one where it looks at your gross income to all your loans, right? And only gross income and only loans per month. And then there's one where they take a look at your total debt, which is, or more or less, they take a look at your total expenses per month compared to your gross income. But your total expenses per month tends to include your NIS and PAYE. So it's more or less a net income to your monthly expenses. And it's a good way for you to get an idea of what your financial health is at the moment. Banks usually, I think banks max out at about 40% for their ratio. I consider 30% a healthy ratio, but banks will usually not lend people over that 40%. Once you reach that, that's usually their cutoff point.
Okay, so we're clarifying. So when we add up all our debt payments, credit cards, mortgages, hire purchase, credit union, everything, and we divide that by our gross salary, the banks will max out at 40%, but you think the recommended ratio should be about 30%?
Should be about 30%, yes.
Okay. So we're using 30% of our gross income to settle debt. Right? That was the one.
Yeah.
That was the one question that I had for myself, just to be sure.
No problem.
And I don't know if there were any questions in the chat.
Yes, Nikita, I have a question here. It's about credit cards.
Okay.
The being lured into a sense of complacency with credit cards, where you think that you have money that you don't have and you spend money that belongs to someone else, and then you have to do the repayment. Can you give us a little bit of your own personal advice as it relates to credit cards and their use?
Okay. So good question or topic. There are only, when it comes to credit cards, there are two types of persons. The persons who are bad at it, and the people who are good at it. You need to decide for yourself which category you fall into. And the difference between the two is very important. Persons who are, if you know you're bad at credit cards, you racked up credit card debt before, you've been unable to service or pay that debt, avoid credit cards. We now live in an age where you have Visa debit cards, so you can make purchases without racking up debt. One of the first things to remember about credit cards is that it's never your money. Not $1 out of it is yours, right? Credit card is essentially a fast loan. And that's the reason why credit cards tend to have some of the highest interest rates. I think the average rate for credit cards in Barbados is 23%. When you think about that in terms of debt, the average car loan now for a new car is around 4.5%. You can get mortgages right now for around 3.5% in interest. Personal loans like student loans, etc., the market is around 9% for those, 7 to 9%. So imagine that your credit card is 23% per annum, right? So it really is not your money, none of it. So if you know you can't manage that, then don't get a credit card. I do not recommend it. You no longer is not a necessity to shop online or to travel. You can have a Visa debit card and do the exact same things you do with a credit card. I actually tell people, if you know you're bad at credit cards, get a separate account that you will use for doing online transactions or for when you're traveling. And part of the reason for that is also security reasons. People don't really mind so much when they get a fraud alert on their credit card because it's not their money. Once they inform the bank will then start the process of investigating, and it may take a little while, but they will eventually not be charged for that money that was stolen, right? But when it's your Visa debit, which is tied to your money, you want to maybe add an additional layer of security and don't give that person possible access from you swiping online or swiping when you travel, by simply setting up an account that has a limited amount of money on it, right? So that's one of the things to tell people to consider. For the persons who are good at credit cards, what makes them good at credit cards is credit cards are neither good or bad, it's just you. People use their credit cards to accumulate points, and those points are then what they use to travel or do anything with. I have a good friend of mine uses his cards for everything. Swipes for groceries, swipes for gas. He could swipe for a mate at the shop. He's going to use his credit card. But immediately after making that purchase, he is going to make a payment of the same amount to his credit card and clear it. So his credit card, his charges never get an opportunity to incur interest, and he was able to get his points. Now that is what I call the good habits of credit cards. And you have to know which type of person you are. Will you be someone who will have bad habits or good habits? And then you just kind of decide if it will work for you or not. And because of his good habits and his practices, he's been able to travel all over the world just on points alone. And that would be points that went towards airfare, went towards hotels, or even tickets for shows, etc. So there is some good to cards, but you just need to know how to use it. I hope that answered your question.
I think it did. Nikita. So I have another question. This is in relation to persons who have been in the game for quite a while, but have made a number of financial blunders and have found themselves in quite a bit of debt. And they're trying to get out of that hole that they've dug for themselves. How would you suggest persons begin dealing with that kind of dynamic in their life?
Okay. So first of all, I'll say that you are not alone. There are many of us who have been through those tough financial periods in our life. So that's the first thing. The next thing is to not dwell on the errors or mistakes that you would have made. So once you've gone past that point, the next step that I always tell people is to put it all down on paper somewhere or whether digitally or otherwise, so you can see what is my current position, what is the hole that I'm in, what are the payments I need to be making each month towards these debts, and what is my total debt, and see and try to find out if there's any way for you to do any types of consolidations. You might not be able to consolidate all of your debts depending on what they are, and obviously what assets you may or may not have, but you might be able to consolidate some of them. And that consolidation, I always tell people consolidations can be good and bad depending on what you do or how you do it really. People sometimes consolidate, they get a lower payment, but in the long run, they're paying way more interest back to the financial institution. You kind of have to find that perfect balance between you achieving your goal, which is easing your monthly or weekly burden, but at the same time making sure that overall you are not putting your net worth to be further out than it needs to be, right? So for someone like that, I would generally sit down with them, take a look at what your current position is and see what we can do in terms of consolidation. And then most importantly, identify how not to fall back into the same areas again. Sometimes a fresh eye, whether with an advisor or otherwise, is always a good suggestion. You might not necessarily always be aware of what are some of the offers out there, as well as not just for the debt, but in terms of getting you back on track for saving and investing in a healthy way. So I hope that helps. And just so you know, Lennox, you need to be able to identify how you're going to repay that debt. If you're going to snowball it, you're going to choose the smallest debt first and just pay off one at a time and go up like that. Every time you clear a debt, the amount that you were paying towards that debt, pay towards the next one. Or is it that you're just going to avalanche and just start at the biggest one and go from there? So I can't really give more specifics other than that without knowing the specifics of this situation.
Thank you, Nikita. I have a last question. Well, it's more of a, well, I'll just go right ahead. I'm your son or daughter, and I've landed my first job. And I want you to give me a pep talk about finance. What would you say to me at that point that I've just gotten my first job?
Okay. Oh, wow. I believe in being honest, open, and frank. So if I were having that conversation now with my son or daughter, first thing I say, I remember my first paycheck. I spent it all. I didn't know where it went. I think it was gone within a week and a half. I was broke before the next payday. It was my first lesson in knowing that I was my own safety net. There wasn't, you've gotten to the point, I got to the point where there's no mommy and daddy coming to save you or give you your weekly lunch money. Learn from the mistakes and the successes of the people before you when it comes to financial planning. Despite what you may think, 10 years, 20 years, 30 years comes in a blink of an eye. And I would relate to them my personal experiences. I remember I'm currently 34. I remember when I was 24 thinking, I have my retirement plan. I invest into it, but I still have some time, 10 years is so far from here. But had I been putting X amount in there over that 10-year period, where my pension plan would be now versus, where it would be had I used that dedication, are two vastly different numbers. One of the things that, and hopefully my child is like me, we're visual and we're number focused or based. I would put that down on paper to let them see how much it is putting aside $100 a month from age 22, let's say that's their first job, all the way to 65, versus starting in your 40s or starting in your late 30s. The visual of how much money you actually save at 65 in those age brackets is a stark difference. So being able to see that, I think that I would like to think that they would take that under consideration. Importantly, I will tell them, enjoy life. However, also plan for it. And you never know, mommy and daddy might not always be here, and you might need to be able to cover for yourself. What I would do is encourage them to do some of the things I mentioned in the early transition, the early transitions life cycle. Get health insurance, keep it no matter what. Get life insurance. It's cheaper when you're younger. And some of the things that I would say to my kids are the things that, traditionally parents didn't really talk about. No one really told you things about financial literacy or education. Might be a combination of they didn't know, or, they didn't think it was what you should have focused on. But times are changing at least. So make sure that they know how certain things work. As simple as it may seem, one of the things that my parents did when I was growing up is every time we would go to the supermarket, my daddy would give me the checkbook and I would write out and fill out the check. And because of that exercise I was doing in primary school, I knew how to fill out a check as an adult. And as simple as a task as that may seem, there are lots of adults who don't know how to do it. So I would hope that before that chat, I would have given my child the basic tools to be able to do certain things and navigate. Using the ATM. Sometimes you might need to get money from the ATM. Let your child go. Let them see how an ATM works. Hopefully people are not still using checks, but if you are, let them fill out a check. Let them see what are the fields they need to fill out. Let them know what the strike at the side means. That's how we learn. Give them an allowance, and people associate allowance meaning being that you have money, so your child has allowance. That's not what it means. It means that the same money that I will give them every day that they are going to come to me and ask me for lunch money, I'm just going to simply give them that money, all of it on Monday, and teach them the responsibility of being able to manage that money for the week and encourage them to save. So little incentives, they want a new PS, they want a car when they turn 16. If you save half of it, I'll put the other half. If you save 3/4, I'll put the quarter. And these are things that you can do to help build that financial independence and that financial education from young. So I would hope that conversation by the time I get there is not as in-depth as it needs to be. But the things that I would encourage: pension plan, health plan, insurance. Looking to purchase piece of land. And this is something that I'll add to you guys here now, just to kind of end off this question. One of the most powerful things that we can do as families is generational wealth transfer. And generational wealth transfer is not all about passing off an account or a trust fund full of money. Sometimes it's as simple as letting our kids start life debt-free, not having a student loan, for example. Or it might be something as simple as letting our kids start with a piece or a parcel of land. It has no house on it. Somebody got the cows on it. It does not matter. But that is how you do generational wealth transfer. and you help the next generation to do just a little bit better than you may have done or you are currently doing. So I'll end that there.
Thank you, Nikita. Very well answered. I'll pass on to Marsha.
I just have one more question. When we were doing the ages, it seemed as though when you got to 45, you went to 60. What about that age group in between there, like 46 to, I guess, 60, preparing for retirement? What should they focus on if they have not developed a financial plan?
So that age group should be doing the same thing as the 40 to 45. At that point in time, you are focusing on your retirement planning, emergency funds, and your family goals. So that more or less continues from that age bracket all the way up until you get to retirement. That's why it's usually left out, so to speak. The goals for our life, if you look at I think it was the early transition, 22 to 28 year olds, you will see some of the same themes reoccurring. Emergency fund is in there, pension plan is in there, etc. Right? But they're now starting out, so they don't need health, they don't need life. As you go on in life, all you're doing is adding on to the things that you have built fundamentals for.
Well, thank you, Nikita. We really did get some pearls of wealth tonight. I just want to be sure from those that there are no other questions in the YouTube chat before I pass over to Reverend Lennox. But I just want to advise those watching to take some time and go back over the YouTube video. There's a lot of information in there that may take some note taking and some pausing and, a little more detailed look. And if we start to implement some of the things that we've learned tonight, despite whatever age we are, I'm sure that it will do us better. We will do better in the future. And we will also have information to pass on to our children to ensure that financial literacy becomes a part of our day-to-day teachings in our families and in our churches. Thank you again, Nikita. Over to you, Reverend Lennox.
Thank you for having me.
Well, let me also join in saying thank you to you, Nikita. We wanted to end our series with a riveting session that would cap off what was really a wonderful family life series. And we indeed had that session, compliments of you, Nikita. So we are delighted that you took the time to come and be with us this evening for our Family Life Enrichment series under the theme, Living Your Best Life. And thank you for all the pearls that you left with us this evening. We are delighted that you were here. I learned a lot from the session. And I believe that all those persons who joined us on YouTube, lots of people were with us on YouTube, and we are delighted that you were able to come and to share with us. So thank you very, very, very much for being with us this evening. And we look forward to having you come and spend some time with us again so that we can again share together. And I look forward to checking you out on the My 2 Cents Worth. I like to see what's happening there.
Thank you very much for having me. Appreciate it.
You are very welcome. So our series began way back on the 11th of May with a session with Tony Olton, general session, Living Your Best Life. Then we continued on the 18th where we looked at marriage vows and uniquely single. We had a panel for the marriage vows. We had the Cottons and we had the Chisholms who were with us. And we also had Paula Richards, who was with us for that session of uniquely single. And then we continued and we had some other very interesting sessions as we went through our series. We looked at Days of Our Lives, the men's edition and the women's edition. We also had Managing the Mind of COVID, with Dr. Renia Boyce and so on. We had a really good series. Last week we looked at gerontology with through the weeks, and we are glad that you were able to join us for these sessions. I want to encourage you to go back and watch this session again, because I'm sure that you were not able to grasp every single thing that was shared, and some of the information shared is worth hearing and seeing twice. I also want to encourage you to go back and watch the other sessions that we would have done in this series as well, and subscribe to our channel so that you get notifications of everything that we are doing. Well, we're going to be returning next Wednesday, right after Father's Day, back to our World Changers Bible Study. And I look forward to having you join us every Wednesday at 7:30 for World Changers Bible Study. We were into a series called Breaking Strongholds, and we are looking at breaking the stronghold of low self-esteem. And so invite your family and friends to come and participate with us as we continue looking at that series. That's going to take us to the end of July, and then we're going to be starting a brand new series. So I look forward to seeing you next time. May God bless you, and I thank you so much for joining us this evening for the culmination of our Family Life Enrichment series. God bless you, and see you next Wednesday.